Good afternoon, ladies and gentlemen. Welcome back to the weekly market review. Today is the 14th of October. Today, as usual, I have my co-host with me, Mr. Gerald. How are you, Gerald?
Hi, I'm very well. It's a rainy Monday in Singapore. Sunny and I just met at an event that we had to attend very early on a Monday morning while it was still raining outside. Sunny, want to tell us a bit more about this event that we were at?
Yes, it's the SGX Financial Literacy Week. So we were at the SGX Securities Market open at 8:30, waiting for them to strike the gong to start the securities market trading. We also saw some new products from SGX, which is the Magnificent 7 DLCs. And of course, a lot of attention is on the Saturday Chinese Finance Ministry briefing. And I know you guys are concerned looking at the charts today. I see that the Hang Seng Index is down. Some of the Hong Kong or Chinese tech stocks are down also. But let's not forget Singapore is a safe haven. So let Gerald take you away with some of the updates in the market today.
Okay, as usual, today's sharing is for information purposes only and should not be taken to be financial advice. We have an upcoming Ask SIAS this Wednesday, 16th of October. So if you'd like to register, you can scan this QR code. The registration will close tomorrow, 15th of October. So do sign up if you're keen to ask Sunny and I questions about what is happening in the Chinese stock market, as well as any other investment considerations that you might be having. Okay, if you find the weekly market review helpful, do leave us a review on Google. And if you would like to join SIAS as a member, you can actually go to this website, sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so we start by going through what happened in the US market. We saw the S&P 500 actually reaching a all-time high, now above the 5,800 level. And we see that the gains are broad-based across some of the value names as well as the growth stocks. And Nasdaq was up by 1.1% as well. Okay, closer to home, we saw the STI down by 0.4%, where some of the correction in the Chinese stocks actually had a spillover to a sentiment in the STI. The key economic data point that came out was the consumer price index data, which gave us an indication of the inflation trends in the US. And based on what we see in the chart here, the core inflation in the US rose by 3.3% in the month of September, and that was a bit higher compared to what investors were expecting. Okay, so if you look at the July and August data, it's moderated to 3.2%, but it actually re-accelerated to 3.3% for the month of September. And that was something that investors took as signs that maybe inflation might be a bit more sticky compared to previous expectations. Okay, so with the latest inflation data, we see that there has been a moderation in expectations around interest rate cuts. If I were to look at the expectations on the remaining meetings for this year, then there is actually a very high probability that investors are assigning towards the Fed just cutting interest rates by 0.25% in each of the upcoming meetings. Okay. And then if I have to look forward into 2025, what we see here is that we might be looking at potentially another 4 rate cuts. And once again, this is a moderation compared to what we were sharing previously, where some investors might be expecting potentially 5 or even 6 rate cuts in 2025. Okay, so this is best illustrated in this chart. It is actually the target rate probabilities for the September 2025 Fed meeting. It gives us an indication around what investors' expectations are on interest rates 1 year later. And if I were to look at what it was 1 month ago on the 30th of September, then we see the highest probability actually for the target interest rate to be at 2.75 to 3%. Okay, so this is represented by the light blue bar on the right. Okay, where we see that, okay, that actually is the one with the highest probability. And that means that investors are expecting quite a number of rate cuts from now until September next year. Okay, but if I were to look at the latest expectations, which is the current one as represented by the dark bar, then what we see here is that the probability has actually come down for it to come down to 2.75 to 3% interest rate. But what has actually increased is the likelihood that the interest rate 1 year down the road will be between 3.25% to 3.5%, or even 3.5 to 3.75%. Okay, so this is actually a representation that investors have moderated their expectations of interest rate cuts with the very strong US economic data, as well as the higher than expected inflation data that has come out. If I were to look at it from a bond yields perspective, what we see here is the US 10-year government bond yield, which has rebounded fairly sharply in the last 1 month. It reached close to 3.6% in September, ahead of the US Federal Reserve meeting. But since then, we have seen a bounce such that it is now at 4.1%, compared to the low of close to 3.6%. Okay, the other key development that many investors are probably looking out for would be the performance of Chinese stocks. Sunny went through the technical analysis of the Hang Seng Index last week. And what we see in the past week is that there's been a correction in the Hang Seng Index. This is driven by some disappointment by investors around the press conference that the China Economic Planning Agency had, which actually led to a correction in the China-related stocks, as represented in the Hang Seng Index or other indices that track this basket of Chinese stocks as well. Okay, if I were to come to the STI, what we see here is that the banks have actually bounced a bit given the improvement in the 10-year government bond yield, and generally expectations that we might not see as sharp a interest rate cut compared to previous expectations. On the other hand, we have seen some of the REITs actually falling with the higher bond yields. Mapletree Logistics Trust down by 3.4%, and Mapletree Pan Asia Commercial Trust down by 4.6%. These REITs have also been impacted because of weaker sentiment towards the Chinese stock market. Okay, so this is a summary of the REITs performance. We have some of the US office REITs actually still having some gains in the past week. But what we see here is that the REITs with China exposure, including CapitaLand China Trust, Mapletree Pan Asia Commercial Trust, having a pullback with the correction in the Hong Kong stock indices. Okay, so there are two names I want to talk a bit more about today. The first is Mapletree Logistics Trust. What we see here is that the share price of Mapletree Logistics Trust recovered from a low of about $1.25, reached close to 150 following the US Fed rate cut, and then in the past week having a bit of a pullback. Okay, so for those of you who are not familiar with Mapletree Logistics Trust, industrial REIT, and if it's to look at the breakdown of its assets, broad-based exposure across many different markets. Singapore will be about 19% of its exposure. But if you were to look at China and Hong Kong, combined, this will represent about 40% of its asset under management. Okay, so that has actually impacted the sentiment towards Mapletree Logistics Trust when there were concerns about the health of the Chinese economy. But then when we saw improved sentiment, we saw Mapletree Logistics Trust having a bit of a bounce as well. Okay, in terms of the recent performance of its China assets, what we see here will be the occupancy rates. As of June 2024, the occupancy rate of its China assets will be at 93.1%, down slightly from where it was in March 24. But if you're to compare that across the different markets that MLT is exposed towards, then the China occupancy rate is actually the lowest. Okay, And then if you look at Hong Kong, that is at 95.6%, also slightly lower compared to the portfolio average. Okay. If you were to look at some of the markets, such as Japan, it is at 98.7%, Singapore at 95.8%. So those markets actually have got higher occupancy rate compared to the China and Hong Kong exposure. Okay, if you were to look at the rental reversions, we also see weaker rental reversions for its portfolio of China assets. So in the first quarter fiscal year 2425, which is the quarter ending June, what we see here is that the reversions were negative 11% for its portfolio in China, versus the average portfolio reversions of positive 2.6%. Okay, so the hope is that with the stimulus that's been announced, that can help to drive up the occupancy rate as well as the rentals that MLT would be able to earn from its China industrial assets. Okay, as a summary around what we see for MLT based on the latest quarterly results, the distribution per unit were down by 9% to 2.068 cents, and that was largely driven by the increase in the finance cost as well as a slight decrease in terms of its net property income. Okay. If it's to look at the aggregate leverage of MLT, it is at 39.6% as of June 2024, just slightly below 40%. So I would say probably nothing that I'll be too worried about. But it is really this fall in distribution per unit that investors will probably be awaiting to see whether we eventually start to see a recovery in the dividends paid out by Mapletree Logistics Trust. Okay, if it's a look at the valuation of MLT at this point in time, price to book of about 1.03 times, which is below the historical average as well as the sector average. And if I were to look at the dividend yield of MLT, now at 6.3%, which is above the historical average as well as the sector average. Okay, next we have got Mapletree Pan Asia Commercial Trust. Quite a similar trajectory to MLT, where we have seen a rebound with the Fed rate cut as well as improved sentiment towards the Chinese market, but having a pullback in the past week as well. Okay, so this is the breakdown of the exposure of Mapletree Pan Asia Commercial Trust. We see that the Hong Kong and China market also represent a significant portion of its gross revenue. Hong Kong is at 21% and China is at 9%. So combined would be 30% for Hong Kong as well as China. And that is the portion that investors might be concerned given the previous week economic performance of China. And that is also where investors are having the expectations that the recent stimulus might be able to help drive some improvement there. Okay, if you were to look at the occupancy rate of the properties that it has, the China properties has a occupancy rate of 88%. So once again, that is the lowest across its portfolio. On average, the portfolio occupancy is 94% as of 30th of June 2024. Okay, if you look at some of the other properties, say Vivo City in Singapore is close to 100% occupied, and even Festival Walk in Hong Kong is also close to 100% occupancy rate. Okay, if you were to look at the rental reversions, it paints a similar picture where the rental reversions of Mapletree Pan Asia Commercial Trust China properties was negative 1.3%. For Festival Walk in Hong Kong, even though it has a very high occupancy, the rental reversions was actually negative 5%. So once again, we see that that is dragging down Mapletree Pan Asia Commercial Trust overall performance. Okay, so with that, we see that the distribution per unit for Mapletree Pan Asia Commercial Trust, 2.09 Singapore cents for the quarter ending June. That was down by 4.1% compared to the same period last year. And this decline is largely driven by the moderation in its gross revenue, as well as an increase in its net finance cost. Okay, if you're to look at the valuation of Mapletree Pan Asia Commercial Trust, price to book of 0.8 times, so below the historical and sector average. Dividend yield of 6.2%, which is above the historical average, as well as the sector average. Okay, so that would be two REITs that have got fairly big movements in the past week. A lot of investors are looking out for how their exposure in Hong Kong and China will actually be impacted by some of the Chinese stimulus that have been announced, as well as whether the interest rate expectations will lead to further movements in the share prices of the Singapore REITs. In terms of what we are looking out for in the week ahead, we just saw the Singapore GDP data announced this morning. We have got the US earnings season going into full swing with more banks reporting this week. And for investors who are looking at the T-bill, we've got a 1-year Singapore T-bill on auction this week. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, for that insightful sharing on some of the counters on the Singapore market as well as the US data. Let's start off with the STI this morning first. So STI this morning is up about 0.4% or 14 points. So you can see that in the past 1 week, the past trading week, the STI is sort of in a range-bound kind of formation, trying to cling on to the 20 days moving average or the Bollinger Band basis, now around the 3,590 points level. So we are at 3,588 points on this Monday morning. So where is the STI likely going to head in the near future? This morning at XGX, our dear friend Jeff Howie, market strategist at XGX, actually shared with us when was after we broke the 6-year high. Okay, I'm going to zoom out my chart a little bit. After we broke the 6-year high in 2018 already, what is the next level that we are looking at? So he actually zoomed out the chart all the way back to 2007. And that was this point over here. Okay, and that is at the 3,900 points level. The comment that he gave me that struck me was, at that point in 2007, do we remember what was the Singapore GDP then? Okay, so GDP then was 9.4%. Okay, so for Singapore stocks to reach that level, our GDP definitely need to improve before we can see such a level. Okay, so that is his comment and his view, and you can look out for the SGX report if you would like to dive deeper into that perspective. Okay, so my perspective, yes, I do agree with that. Even the technicals on the charts also agree with that. We have touched a 6-year high. The near-term resistance definitely will still be the 6-year high at 3,652 points. Support level will come in the previous high, which is what we saw somewhere around the 15th of July at 3,512 points, or the 3,500 points round handle. I will be saying that will be the key support to watch out for. That also coincides with the blue line, which is the 50 days exponential moving average, now at 3,512 points, 3,509 points, so confluence over there. And then the lower bound of the Bollinger Band at 3,555, so a lot of key levels surrounding the 3,500 handle. That will be the key level to watch. I believe we will see some bounce on the STI index around the 3,500 points level. On the indicator side, you have a negative reading on the MACD indicator. It has been on a downtrend since the beginning of October. So no surprising that the downtrend will likely continue based on the MACD indicator measurement of the negative momentum. The RSI also had a retracement back, now reading at 57 from the 14 days moving average of 60. So it will only likely have some sign of a support or bounce towards the 50-point neutral mark, which is about 7 points away right now. Okay, from the high that we saw in mid part of September, where it go into the overbought session. Okay, so STI likely going to be a range-bound formation. Support is at 3,005, resistance 3,650 points, which is the 6-year high or the year-to-date high. Okay, next, let's move to the Hang Seng Index, which you guys are very concerned about, and of course myself also. So Gerald actually texted me, some of you actually also text me, some of my friends also text me that, hey, we saw that the mention of the 20,800 point level, which was the previous high that we saw in April 2023 last year, having a little bit of a bounce this morning as well as last Friday. So is this the support level that we are looking at? Is this the level that we are going to get in on the Hang Seng Index? So like I said, this is a support level. I already dipped my toes in, but I don't suggest you go all in, because as of what the latest Chinese ministry briefing on Saturday, there wasn't any concrete figure given. There wasn't any headline figures that was given on the stimulus measures. Market is looking at 2 trillion to 3 trillion yuan of market stimulus, but they got nothing. So definitely the momentum or the sentiment now is still very negative. If you look at the indicator-wise, the MACD indicator is starting to cross the signal line already. And a crossover happens, it signifies the confirmation of a downtrend formation. Thereby, the MACD reading will go into the negative reading. We can also see the RSI hit the overbought level of 70. It reached a high of somewhere in the 90-point region on the early part of October and have now retraced back to the 58 points level. So last week, I actually said that the first support is at 20,800. We are still holding on to that level right now. Hang Seng Index is trading around 20,860 points right now. But I do believe with the crossover of the MACD happening and the RSI looking to trend down further, there will be a lot more pressure on the Hang Seng Index, and the next support level would be the 20,000 handle, which is referencing the high that we saw in May this year. Okay, so the May high on 20th of May is around the level of 19,700 points, and if you round that off, that will be a 20,000 handle that we should be looking out for. So with the lack of a stimulus, I think market will be taking off some of the profits that they have put in over here, that run out over here in the month of September or during the Golden Week. And I hope you did your risk management and position sizing properly and did not go into a big position on the 20,800. You should be staggering yourself between the 20,800 and the 20,000 level. Okay, so in the middle, that is where the ideal place that you should be. And of course, the target will be the recent high at the 23,241 points. Okay, so that's my take on the Hang Seng Index. Do trade very carefully. And I would like to add some comments over here, the starting of the Chinese market. So as you guys have known, I have sort of neglected or have not touched on the Chinese or Hong Kong markets for the past 1 year at least. Actually, I have not even looked at the Chinese market for the past 1 or 2 years after some of the crackdown by the Chinese government on the tech companies, on the gaming companies, and the financial company, and financial in particular. So I believe this is still a policy shift towards the better, but then we need to see concrete measures. But how would you read the Chinese market if you are reading it from a fundamentals perspective, like what Gerald always do? But then the key thing that you need to note is that the China accounting practices or the numbers that they publish may not be 100% accurate. We have seen some of scandals in the past. On the technical side of things, even if I can use the technical analysis to measure or to see how is the market sentiment like, what is the momentum like, any shift in policy, any change in direction of what the Chinese government wants to say, all your fundamental analysis, all your technical analysis go out of the window. That is the reason why in the past few years, I have not covered much on the Chinese or the Hong Kong markets. But this time around, I believe the change in policy direction is true, but then they will not give you a bazooka. They will not give you a 3 trillion or 2 trillion kind of number to boost up the economy like what the Western economy tends to do. They would just want a very slow and stable recovery. They will just give bits and pieces. So you should be staggering yourself into the trades and then go in for the long ride rather than looking for a quick rebound, which is likely not going to be lasting very long. Okay, so do trade carefully on the Hang Seng Index and the Chinese market, especially the Chinese tech stock. Hang Seng Tech Index is down 3.5% today. Hang Seng Index at this point, 11 a.m. is down 1.75%. Okay, next let's move to the US markets. Very good news here. US market continue to power ahead with the new all-time high seen on the Dow Jones Index and the S&P 500. So we got a new all-time high on the Dow Jones Index already. I believe the main catalyst, not only the CPI data that was a bit too hot. Going forward, as inflation starts to cool, the focus of the market or investors will be on the health of the US economy, meaning that the data of the CPI would be less impactful compared to employment data like the non-farm payroll data. Okay, so it's not a worry that inflation is going to be sticky. It's just that will only mean that the rate cut will not come down so soon or so fast. But that also means on the flip side that US economy is still doing well, consumers are still spending, hence there is no worry and have a very good chance of getting a soft landing. Okay, so at the all-time high Dow Jones Index, definitely we will not go and sort of go for to chase the high that we are seeing right now. As you can see, the first support level would definitely be over here. That is the 20 days moving average at 42,123 points, followed by the lower bound of the Bollinger Band coinciding with the 50 days exponential moving average around the 41,497 points or the 41,376 point level. Okay, so I believe this trend will continue, and it's just that we need to get in on a better risk and reward ratio towards the support on the 50 days moving average or the lower bound of the Bollinger Band. Okay, we still have a positive reading on the MACD indicator on the spike of last Friday. And the RSI is also very close to the 70-point overbought level. So we got to be careful over here. The US markets or the US Wall Street actually started their earnings season already last Friday with JP Morgan and Wells Fargo reporting some strong results. So taking that as a barometer of your US economic health, I think that's a very good sign for the remainder of the earnings season. And definitely I am positive that we might still see some all-time high, but we want to get in on the support level, which is the 20 days and the 50 days moving average. Okay. Next, S&P 500, my target was 5,800 points for this year. It looks to me that we have already reached that level after closing at 5,815 points. So that is a positive sign. And looking at the behavior of the S&P 500 index chart, it looks quite similar to the Dow Jones index. So we can see that we have a new all-time high, and then we have a new all-time close. The MACD indicator still have some positive reading on the spike of last Friday jump due to the big banks earnings results. And the RSI is also close to the 70-point overbought mark. So do be careful. Chart is a bit toppish right now. Just wait for it to retrace back to the 20 days moving average and the 50 days moving average now at 5,721 points and 5,624 points, which is the lower bound of the Bollinger Band and the 50 days moving average now coinciding together over here. That will give you a lot of a firmer and stronger support level to look at for the S&P 500. Okay, next let's move to the Nasdaq Composite Index. You realize that Nasdaq Composite Index sort of is some kind of a lagger behind the Dow Jones and the S&P 500. This is not a surprise because previously the tech stock has a very high valuation, and we are seeing the rally now sort of spreading out to the other sectors of the economy. Hence, the S&P 500 and the Dow Jones are catching up very well now ahead of the Nasdaq Composite Index. So Nasdaq Composite Index year-to-date high is still at 18,671 points. Actually, that was the all-time high. And that will definitely be the resistance level to watch out for. On the support side, comparing to the S&P 500 and Dow Jones Index, I would actually prefer to use the 100 days moving average, which is the amber line that you see here at 17,406 points. That would be the support level I'm looking at to get into the Nasdaq Composite Index whenever there's a retracement. Okay, so not needless to say, if you touch the 200 days moving average, a lot of investors will definitely be piling in, regardless of which index you are looking at. Okay. So looking at the indicator wise, we still have a positive reading for the MACD indicator. So we still have some room to grow. So among all the indices right now, I'm more positive on the Nasdaq Composite Index in near-term trading because there's more headroom for us to touch or challenge the all-time high again somewhere in the July period. So we see that the RSI is at 62, also a positive reading, and we have a wider gap towards the 70-point mark, which is the overbought level. So there's more room to grow, and we are looking forward to the tech stocks earnings that's coming up. And of course, the closely watched NVIDIA Blackwell chip sales, which I think could be a positive surprise over there because the TSMC sales result was quite good. Okay, so I think overall US is still in a very good light, a very positive kind of a sentiment and momentum and environment, given that the economic situation there is still very well. So do look out for some of this movement that will be coming out in the earnings seasons that will drive the US market going forward. Okay, so that is the time that we have for today. Gerald, anything else you like to know or you think your audience would like to know as well?
I think there are still a lot of macro developments, both in the US as well as now China, which is what many investors are looking out for. We are also going to the last earnings season for 2024. I was discussing with Sunny earlier whether he is looking to close his trading book soon. So I think we are approaching the end of the year, and hopefully over the next few weeks, we'll get more clarity on the economic picture, and we will actually be able to see the continued strong performance for some of these indices.
Yes, Gerald, thanks for reminding. Some of our audience asked me, so how do we like go looking towards the end of the year? What are we looking at? So we still have the US election coming. December, usually I'm on leave and on holiday, and I don't trade on December. I believe most of us are away in December. So how long more do we have to play? We still have about 1.5 months, taking November into account and the US election. So most probably, yeah, if let's say the market has another bounce up, we will be closing our books on the high. The US indices are up 20% this week, this year, and STI is up 10%. So I think we had a very good year, and I believe most of you have made some money as well. So things are looking good, and you should be, if you are already in the money, you should consider taking some risk off the table and start to position yourself towards next year already. Okay, so that's our take that we have for this week. We thank you again for joining us as usual on our weekly market review, and we will come back again next Monday, same time, same place, and we will see you again. Goodbye.
See you.